Paul, thank you so much for coming on today. I know every single person we've talked to has no idea that they can actually access their 401k and they can pull from it to either start a business from scratch, purchase a business, which is obviously a shortcut, or use it for an existing business that they have. So I would love to start there. You know, obviously these tech layoffs are in the news every single day lately, which is super unfortunate and breaks my heart to see these people that work for these large tech companies just get laid off overnight. But that's a perfect time to possibly tap into their investment portfolio. So let's start there. I'd love for you to introduce yourself and kind of help explain away the Rob's IRA.
Yeah, thanks for having me. First off, I appreciate it. It was great to meet you at the IBBA show in Denver. So I'm glad to be able to see your face here again. It's funny, the downside in the economy sometimes is people, as you say, get laid off or even self-select out and move on to do something different. Opens up doors for people as well, and that's what we're excited about. But the key is this thing called ROBS, and I use air quotes around ROBS, but it's the acronym that stands for Rollover for Business Startup, right? And that was coined by the IRS back in 2008, I think. So it's been around for 40 plus years. We've been doing it for almost 20. But the gist of it is this: instead of having your retirement account invest in, Coca-Cola or Microsoft or General Motors stock, your retirement account can be used to buy stock in your own company. So it's like bringing a partner into your business, and your partner is your retirement account. It literally, physically is an investor in your business. Now, it has to be set up the right way, and we can talk about the nuts and bolts of that. It's got to meet IRS guidelines. We help you avoid the taxes and penalties. But in a nutshell, that's it. You're just rolling your monies over to a vehicle that allow you now to have the access to that capital to either start up that business or go buy a business. It's a super venture.
Love that. I know. And I'm so glad bringing you on because you're the only one that can explain it in layman's terms. And I love to use that perfect example, because you're right. A lot of times they'll use their 401k and they're buying stock in Coca-Cola and all these companies, but why not be your own bank, and it's tax, it's penalty free, I've told, because that's their very next question, right? So if you want to talk about any, are they going to get hurt at all as far as tax penalties?
Yeah, let's address that. We've been taught our whole lives not to touch our retirement account until we're old, right? Because we can't, and that's what we know, and that's what people remember. But we've always been able to invest our retirement dollars into what I call non-traditional assets, right? And a non-traditional asset might be, in this case, private stock in your own business. So we're going to go out and we're going to form, step one, we'll form a corporation for your new company, call it New Corp. We'll form a brand new 401k. So you've got these two empty entities waiting to be funded. You now call up your old broker, your old IRA 401k provider, and say, hey, it's Christine. I want to roll over my 100 grand or 500 grand or whatever the number is. And when money rolls over, all right, those funds aren't taxed or penalized because it's staying in a qualified retirement account. It's rolling over to this New Corp 401k. So no taxes or penalties. And again, instead of calling up your broker and saying, buy stock in Coke or GM, I want to buy stock in Christine's New Corp, your own business, right? So now the cash has moved twice. It rolled over into new 401k, no tax, no penalty. Then it made its investment by literally physically writing a check to New Corp in exchange for shares. So this new 401k is empty, doesn't have any money in it. It owns stock of Christine's New Corp. New Corp bank account at, local bank of your choice has the cash to either go do your startup or, in a lot of cases, use this money as the down payment towards, say, an SBA loan for this, larger acquisition that you're trying to do. So again, like you said, bet on yourself, right? Invest in your own company. Who knows what's going to happen in Wall Street? It's going crazy today. If everybody's watching, by the way, today's June 10th. So if anyone looks back on this date in history, so far we're down quite a bit. But move your money out of Wall Street, which is unpredictable. Buy stock in your own company. Last comment there. That's unpredictable as well, right? You're taking a bunch of money and you're putting it in a single company, which you might not do on Wall Street. But at least it's a company that you run, own, operate, control. your decision making, your work ethic, everything you're bringing to the table is what you're really investing in, and that is, in this case, Christine's new corp. All right, as our example.
Yes, and Christine's new corp can't lay off Christine because Christine is the owner.
Could. If
All
Christine's
these,
not performing, she might have a conversation with herself.
yeah,
But
maybe, but that's kind of the magic, and that's, you know, all these recent phone call, you know, we've been, well, and that's why it was so fun meeting you, because one of our transactions back in December did exactly this. They said, hey, we're going to pull, you know, he was in corporate hell. So he's like,
mhm.
but he, by chance, their company had been acquired by a larger corporation. And I know that's another very rare instance. So, you know, either you got fired, you got laid off, or your current company got acquired. And then it's
Mhm.
that little window of time where you can pull from the 401k typically in most
Yeah.
cases, right?
Yeah, you
And
could. It depends on that transaction and whether or not they're going to completely change retirement benefits for employees. But yeah, sometimes on a corporate buyout like that, there's that little window where your funds could get freed up and you could move them. Really, could just move them out to an IRA, or in this case, you'd be moving them to this new 401k that then could fund your new corporation.
yeah, and it's funny because he had said, "Oh, I've got a Rob's IRA, so, you know, I'm going to do," and I had to Google Rob's, like ROB. I was like, "What is that?" I didn't even know that back in December. So, you know, this was news to me. And again, even some colleagues of mine, I'd asked, "Hey, have you ever heard of this program?" And they hadn't. And it's just, yeah, it's just this magical way that people can now kind of control their own destinies if they do have a decent 401k. I know you guys typically look for at least 50,000, correct?
Yeah, I mean, really based on costs, right? It's a flat fee. Let's talk about costs. We charge 5 grand to set up everything. Takes us about a month or so. Kind of depends on you, but we're filing your corp, creating your plan, all of the quote unquote legal work to put everything together is all wrapped up in that 5 grand fee. So if you look at, let's say it's a rollover of only like 30K. Well, if you're going to roll over 30K and pay me five, I would probably argue, why not take just the distribution, take the 10% hit. So 10% of 30 is only 3 grand. And then you might be able to write off some of the taxes in your initial, year one startup costs or losses of the business, right? So when you get to about 40 or 50K, it makes sense to really start looking at Rob's. Obviously, if you're rolling over, 500,000, it's a no brainer because it's still only 5 grand to get everything set up. So
No, and that's super. When you told me that that was your guys' fee to do the whole everything, the whole package, that's super reasonable for sure. Because that's
yeah,
everybody's
definitely.
next question. And within a month, I'm just like, yes. So, you know, everybody watching, everybody listening, you know, you can still submit that offer, that LOI, you know, a strong LOI when you go to purchase a business. And you can write that into the LOI so that that you're starting that process, you know, and then that's just part of the due diligence and the, you know, obviously if you're already a strong buyer, the seller shouldn't have a problem with that. They understand that you're going through this, you know, putting this thing together, and it's going to take 4 weeks, 4 to 6 weeks. Have you ever seen them not go in what instances would they not go through?
Oh gosh, that's a great question. We usually do enough diligence on the front end when we're talking to you that we know it's going to work. I've had a couple of people say, yeah, I can roll my money over. And I'm asking, are you sure? Have you checked? What kind of an account is it again? I had a person who actually thought he had a 401k. It was a pension, and it
Oh,
was a pension tied to a structure that was only going to be paid out, on a monthly pension check at the age of 55. And he was, I can't remember his age, 40 something, right? And he signed our paperwork and said, yeah, I've checked, I can move my monies. And a couple of weeks in, he reaches back out to his pension provider and he finds out he can't roll his money over. Now, we refunded what we could of his fee, of course, and tried to make right. But we dig really deep, make sure that you have double checked that you can roll those funds. There's really only a couple counts for sure you can't roll over. Sometimes pensions, those are odd. Dig deep with the pension provider. A current employer plan. So you haven't been laid off or haven't quit corporate America yet. You're under the age of 59 and a half. You've been there for 10, 15 years. You can't roll that money out until you quit your job. So if leaving the job is not part of the equation, then maybe this won't work for you. Roth IRAs, because a Roth IRA has already been taxed. You can't roll it back into a tax deferred vehicle. So you can't use a Roth IRA. And you typically can't use an inherited IRA unless that inheritance is from a spouse, which would be very sad and weird and not very common. Because usually when we inherit retirement accounts, we're inheriting from our parents or grandparents. You cannot use one of those inherited accounts, but everything else should be doable.
So then how many days can you typically pre-qual somebody, they're going to check, you guys make sure that they can roll it over? Does it take a couple days, a week, like that portion of it?
Yeah, I mean, it's on you, because I can't call up Christine's plan provider and say, hey, it's Paul at Guyton, I want to know if she can roll her funds. They'll laugh at me before they hang up the phone, right? So we're going to give you the language. It's really just two questions. Hey, can I roll my money over? Yes or no, to a qualified plan. So you need to ask that of your provider. I wouldn't email it. I would pick up the phone and call somebody just to make sure you're hearing the answer you want to hear. Second question should be, how long does it typically take to do a rollover? Because some providers take longer than others. That's the linchpin of the timeline, is the rollover itself, because we don't touch your money or hold your money through the process. We just make sure everything's set up the right way. And then you direct that step of the rollover. That can be an instantaneous wire transfer, once you have the proper paperwork to the provider. But most providers, quite honestly, they still cut a hard copy check, mail it U.S. Postal Service, send it to the new Corp 401k account, and that's the foot dragging piece of the timetable usually. So.
I know. And here at the Magnolia firm, our transactions go so fast. It's like every day, every hour counts. So that's why I think I had asked you 3 times over. I'm like, wait, how long? Are you sure it's done that within? But yeah, it's dependent on that.
Well, let's address that timing too, because it's awesome that you guys are doing speedy transactions. But you're going to be beholden to sellers sometimes. You're beholden to landlords. You're beholden to franchisors if it's a franchise concept. A bank is going to delay things. A Rob structure, right? A setup of that can get in the way too. So from a timing perspective, get pre-qualified is not the right word. Get your information about Rob's, your understanding about Rob's earlier on, and or I'll say even get started on Rob's earlier on, so that you are a better, more qualified buyer and borrower, for one thing, but also so that you don't run into some unforeseen delay of, say, the movement of the money, right before the deal has to close. And now you got to go back to the seller and say, hey, we need to extend the close date. You're running a little bit of risk there of, fouling up a deal. So certainly we want to talk to you sooner rather than later. Understand if you're qualified sooner rather than later, which will help you, know what your buying power now is as well. What funds that you didn't know you had available.
I love that. And that's great advice. Again, everybody listening, watching, yes, actually talk to them before, like if you're serious about using your funds to be your own bank, pull from your own bank and of your 401k and your investments to purchase a business. Yeah, definitely start that conversation sooner than later, because you don't have to have an exact business even picked out.
Correct.
To put this in that entity. And that entity, is it a C Corp that you guys are
C Corp? Yeah, it's got to be a C Corp. That's one of the IRS guidelines, just because of the specific type of private stock that's being sold. 401k can't own stock of an S Corp. Just one of the funky rules. But again, we set all that up for you, and there's pros and cons to all corporate entities, but we can talk to you a little bit about tax strategy as well.
Awesome. And then talk about SBA. So, let's say somebody wants to make they're going to get an SBA for a larger acquisition. Usually typically SBA right now, what they want 10 to 20% of your own funds put in, skin in the game.
Yeah. So 10% is your minimum. That's an SBA requirement, right? Banks may want more because they're the bank, right? They want to protect themselves. And I say it that way because an SBA guaranteed loan is not, guaranteed that Christine's going to get a loan. It's guaranteed that the loan is protected by the federal government, and the bank is guaranteed protection up to 75% of that loan amount. So that's what a guaranteed government loan program is. So if a bank only collects the minimum 10% down and the SBA is only guaranteeing 75%, the bank's got that delta, that 10, 15% delta there, that they're exposed, they're at risk. Now, they're not going to lend on a deal they don't like anyway, so they're mitigating their risk. But some banks might require a greater down payment. I always say go into it, hoping you're going to get 10% down, but plan you're going to pay 20% down, just so that you've got that flexibility, that wiggle room. Because if you're just scraping by to get the 10% down and get approved, and maybe you're a marginal borrower because of, I don't know, credit or business experience, or maybe the business is a little bit weaker than it needs to be in the bank size, they're going to want more down on all of those instances. So again, 10% your minimum. Think you're going to come in at 20, and if you come in at 10, hey, good for you. You got a little bit of extra capital in the operating account to work with.
Awesome. Oh my
Yeah.
gosh. Okay. You covered a lot. You covered all my notes. Is there any other things that people should be aware of, know about? Any other common questions you get asked?
Yeah, well, way back when I started back in '06, the first question was, "Is this legal?" Right, and I had to spend a half hour talking about legalities of Rob's, and that's passed. But the reason why I think even your comment about nobody knows about this is accurate, because look at it from a holistic perspective. You've got these big, Merrill Lynch's, Fidelity Investments, Charles Schwab's of the world. They're not going to tell you about Rob's, because they don't want you to pull your money out and go invest it in your own company. They don't make any money off of stock of Christine's New Corp. All right. So even if they know about it, which a lot of them still don't, they're not going to advertise it or tell you about it. Your average accountant and attorney, I put them in the conservative level just from a mindset perspective. So they're not going to investigate or tell you that you could or should use your retirement account, because they're more conservative by nature. Don't touch your retirement account till you're old. And that's what we were taught. That's the final comment. We were taught that our whole lives, right? You can't tap into your retirement account until you used to be 70. Now it's 72. Well, that's when we're required to take distributions. We can start taking distributions at 59 and a half. But all of those comments about, why folks don't know about Rob's, I think are common sense, but also should make you more curious, and should make you want to learn about it. Like I said, since 1974, when the ERISA Act was created and written, the Employee Retirement Income Securities Act, there was language in there that said, yeah, you can invest your retirement account whatever you want, but there's rules to follow, because it's still your retirement account, and the government still wants their tax dollars someday, right? So if I buy my own business, let's say with my retirement account, and I don't know, double the size of my business, I run it for the next 10, 15 years, pay myself a good salary, control my hours, control my income, have fun, and someday sell my business. Well, if my partner was my retirement account, and I say I sell it for double, right? So the value of my retirement account is now worth double. So that's going to go back into a retirement account, right? You've got closing costs and fees and whatever to sell your business, but it's going to go back into my retirement account. But now I've got a bigger retirement account. And the IRS is still out here. They're going to want their tax dollars someday, and they're happy that your investment went up, right? Because now they're going to get more tax dollars someday from you. And that someday still is in the future, usually, when we're now, semi-retired or whatever we're going to call it, and we're now living off of that retirement account. We're taking that monthly or that quarterly distribution. So all that said, it can work. Talk to the experts. We've been doing this for, like I said, almost 20 years. We're the number one Rob's provider. And I love to hear what your story is. What kind of business and why? That's what intrigues me the most. I'll help you get it funded if we can. But why are you doing what you're doing? I'm curious. It's got me looking at businesses all the time. In fact, I looked at one yesterday. I'm getting off track here, but it's a kayak bike tour business out on the peninsula in Washington, about an hour from me. It's a great price. The numbers look awesome. I'm this close to maybe saying goodbye to Rob's and guidance and doing this.
No, Paul,
But it's only 6 months out of the year, and I'm thinking, oh, is it going to be enough? It'll be fun, but so I'm not sure yet.
And I just loved your walkthrough example, because, again, when our sellers are exiting, they never had any retirement vehicles set in place of any sorts, and they're getting hit with the capital gains, right? Like,
Yeah.
ouch. Like, I love that you're like, whoa, then you just put it back in that. You put it back in there.
Yeah. There's some great benefits on the exit side of things as well. Again, it's all tax strategy throughout the life of your company and when you sell it, and those are things that we talk about in a much more detailed conversation. But we'll help you work through that. It's fun knowing that you bet on yourself and you use your retirement account to do so. A little bit risky, all right, but if the excitement doesn't outweigh the risk, you shouldn't be an entrepreneur anyway, right? So you got to have both. You got to have some fear and excitement. The excitement's always got to outweigh the fear.
I mean, it's worth it for the freedom. Come on.
Exactly.
For a lot of us,
Exactly.
it's a fair trade-off for sure.
Yeah.
And then I had one last question. Oh, because we got a kick out of like how the IRS came up with the acronym ROBS, right? Like, did you want to touch on that real quick? Just kind of the
Yeah, it's funny. So 1974, the ERISA Act, right? Yes, all the rules about what you can do with retirement accounts, and they evolve year over year, but that's when it was started. In 2008, the then deputy director of the IRS kept seeing these things come across his desk about investing in your own business and checking with the auditors in the field. And they didn't know what the heck he was talking about, and they're IRS auditors. And so they coined the term ROBS, right? Rollover for business startup. Probably, well, because they didn't have a better name for it, but also maybe as a warning shot across the bow. You're robbing your retirement account, and we want them to call it bros, right? But bros didn't make sense either. Business rollover startup, yeah, that was dumb too. But we called our structure was a Latin term called Adeo, which stood for helmsman of one ship. That was our own little internal lingo and it never stuck, I should say, and never caught on. But anyway, we deal with ROBS. It's easier to say ROBS than it is rollover for business startup all the time. So we live with it.
you're robbing your retirement fund. So yeah,
Yeah. Yeah.
probably not the nicest term. But yeah, so the IRS is trying to deter people from doing that, I guess, obviously.
That's what we thought. Just by the name, it's like great, what a great name. But we ran with it and marketed it, and now that's what everybody knows is Rob. So thanks to the IRS brand ambassador for coming up with that one for us. So.
But then to that exact point though, so it's rollovers for business startups. So then some people think, oh, I can only use it to start a business.
Yeah,
right?
another misnomer. Yeah, it because it's written right in the name. You think I can't use it for acquisition? Well, that's 100% wrong. In fact, probably most of the clients we talk to are doing acquisitions, maybe 60-40 acquisitions versus startups. Depends on any given month. But yeah, you can use these funds for acquisition. You can use it for startup. Heck, you can use it for equity injection of a current business that you have.
No, and I knew that was the third way you can use it. How often do you see that? Is that pretty rare? Like what percent? Like 60-40, like if you split it up between the three, what percentage?
Yeah, 1 in 10 maybe on the equity injection, probably more like 1 in 100, because most existing businesses are either injecting more capital in out of their pocket, or they're going out and getting another loan if they can, or they're crowdfunding or friends and family or whatever it might be. They don't look to ROBS, I think, as an equity injection, more so because of again, not knowing about it, but also, do I have to change my entity structure? Maybe there's some things like that of an existing business where if it's a new client that's either starting up or doing an acquisition, it's easier for us to kind of create everything from the ground up versus trying to recapitalize some current structure that exists. It can be done. It's just not as frequent.
Awesome. Okay. Any other last minute FAQs, questions you get asked? That was
a
good one.
Yeah, I think, yeah, that still sticks in my head because that's what I spent most of my time on the first 5-ish years or so. But, I think that is, it's always about how come I haven't heard about this? Is this legal? Doesn't come up as much, obviously. How do I really avoid taxes and penalties? What's a good exit strategy? All of those things. Everybody should at least have some kind of plan in place about what their exit strategy is going into a business. So we can talk to them about that, up front on day one. Can I use multiple accounts? Yes. Can I bring a spouse's account in? Yes. Do the fees change if I do either of those things? No. Right. So it doesn't matter the number of accounts or the number of people rolling over accounts. It's still the same setup. We have to do it all the right way. You're just pulling money from different sources and bringing those different funds into that business. That's all.
That's awesome, Paul. Oh my gosh, this was so helpful, so timely. Every day I'm getting press releases about these tech layoffs, and I'm like, oh my God, I've got to get
Yeah.
this out, because a lot of them have, a lot of them luckily had some nice healthy investment accounts, and I don't think they know that they can do this. So thank you for coming on. Anybody
You
watching,
bet.
listening, of course, getting in touch. We'll put you right in touch with Paul. And yeah, we can help support. He's so helpful, right? And just wealth of knowledge. And so we're happy to support in any way we can. So thank you so much for coming on today.
Yeah. Thanks for having me, Christine. It's a pleasure to meet you again. And nice seeing everybody out there. Give us a call. We'll help you out.
Perfect. Thanks.